How do macroeconomic factors affect capital market performance? Imagine a vast financial landscape where countless elements influence the movement of investments and the value of assets. Understanding how broad economic forces shape this terrain can reveal why markets rise or fall and how investors respond to changing conditions. Macroeconomic factors encompass a wide range of indicators that reflected the overall health and direction of an economy. These include gross domestic product growth rates, inflation levels, unemployment figures, interest rates, fiscal policies, and international trade balances. Each of these elements plays a crucial role in shaping investor sentiment and market dynamics. Gross domestic product growth indicates how quickly an economy is expanding. When the gross domestic product increases steadily, it often signals a healthy economy, encouraging investors to buy stocks and bonds. Conversely, sluggish or negative growth can lead to decreased confidence, prompting sell-offs and declining asset prices. Inflation measures the rate at which prices for goods and services rise. Moderate inflation is generally viewed as a sign of a growing economy, but excessive inflation erodes purchasing power and can lead to higher interest rates. Elevated interest rates tend to make borrowing more expensive, which can reduce corporate profits and slow economic activity, negatively impacting capital markets. On the other hand, deflation or very low inflation might indicate weak demand, which can also dampen market performance. Unemployment figures reveal the availability of jobs and the overall employment climate. High unemployment suggests economic distress, leading to lower consumer spending and corporate earnings, which can depress market values. Conversely, low unemployment often correlates with increased consumer confidence and higher market performance. Interest rates set by central banks influence borrowing costs for businesses and consumers. When interest rates rise, the cost of financing increases, potentially reducing corporate investment and consumer spending. This can lead to lower stock prices and bond yields. Conversely, lowering interest rates can stimulate economic activity, often resulting in higher market valuations. Fiscal policies, including government spending and taxation, directly impact economic growth and investor confidence. Expansionary policies, such as increased government expenditure or tax cuts, can boost economic activity and support rising markets. Conversely, contractionary policies may slow growth and lead to market declines. International trade balances also influence capital markets. A trade surplus can strengthen a country's currency and boost investor confidence, while a trade deficit might weaken the currency and introduce volatility. In essence, macroeconomic factors serve as the foundational backdrop against which all market activity unfolds. Changes in these indicators can alter investor expectations, influence corporate profitability, and ultimately determine the performance of capital markets over time. Recognizing these relationships helps investors make informed decisions aligned with the broader economic environment.